Welcome to the cutting edge of the global awakening.
In the councils of government, we must guard against the acquisition of unwarranted influence by the military-industrial complex.
Well, it looks like the North Tower of the World Trade Center has just completely collapsed.
The U.S. dollar's status as the preeminent reserve currency is under attack.
This is a mathematical fact. Tens of trillions of dollars are being extracted from the United States of America.
You really want the truth? Then just follow the money.
Welcome to Follow the Money Radio, a broadcast dedicated to your personal, spiritual, and financial liberty. And now, here's your voice of reason in the midst of global chaos, economist and best-selling author, Jerry Robinson.
Greetings, friends. Welcome to you all over the world. So glad that you're joining us on Follow the Money Weekly Radio. My name is Jerry Robinson. I am your host, your guide, leading you on an excursion to truth in this crazy, chaotic world that we find ourselves in, especially the investment world. What a yo-yo that the stock markets have been this week. I mean, you take a look at the S&P, you look at Japan in particular. Ooh, the Japan trade has turned around a little bit. The uptrend is still intact, but the overall indices have been falling fairly sharply. In fact, Japan has been suffering from the sharpest decline since the Fukushima event back in 2011, I guess. So, yeah, Japan's been kind of a tough market as of late. But we're also seeing lots of yo-yo action in the United States markets, also in the Euro markets. And a lot of it, what it has to do with is the idea of investors that the Fed is going to stop the easing. And, of course, that has also had an impact on gold and silver. Gold is now consolidating above that $1,400 level, which is very encouraging. But we have a lot on the program. I don't have a whole lot of time here in this very first segment because I want to bring on Tom Cloud. He's going to be here in an interview to discuss the latest in gold and silver, and in particular, palladium. He's very bullish on palladium. He's been making that call now for the last couple of weeks, and it's been working. And he has some data that he wants to share on why palladium should outperform all the other precious metals this year. But also he's going to provide an outlook for gold and silver for the rest of this year as well, for those of you who are holding that. And I know it can be nervous and nerve-wracking sometimes watching the metals do what they do. So hopefully Tom will provide some sound wisdom on that, as he always does. We're also going to be joined by best-selling author John Rubino. He's a good friend of the show. He's been on several times. He wrote a book called Clean Money, and it's all about the solar, the alternative energy, and how to actually make money with it. And if you've been paying attention to those stocks as of late, they have been roaring. Remember Tesla Motors, that's been around, for some time now. They really began their upward ascent back in April of this year, and just over the last couple of months, they have returned over 200%. Those shares have. They're the electric car company run by Elon Musk. Also, there is the ETF that many people are using to get access to solar, and while that has had a hard time over the last several years, just over the last 3 months, it's provided a 47% return. Again, beginning to move up in April. And so is this rally that began in April of this year, is it going to continue? Well, John Rubino will be here along with his favorite investments, and he'll be sharing with that. Of course, we'll have Jay Peroni with his investing idea of the week, and we'll also have John Burbs here with his retirement minute. Before we move on, just a couple of pieces of news and also one update. If we take a look around the United States here, the economic data, just a couple of key points that you need to know this week. First of all, U.S. home prices rose by nearly 11% in March, according to the latest report. That's from a year earlier, so they're up 11%. And the biggest house gains in the United States have been occurring out west. We have seen about a 22% increase in Phoenix, 22% increase in San Francisco, 20% in Las Vegas. And then if you go over to the East Coast, you'll find that areas like New York City and a few other areas are kind of more sluggish, but they're still growing, and that's positive for real estate investors. In fact, we've seen the biggest gain in real estate prices year over year in this latest report than we have since the pre-crisis era of 2006. Applications for building permits are hitting a 5-year high. The housing recovery seems to be taking hold across the country. We've certainly seen that in the equity markets as the housing stocks and home builders have just been really outperforming over the last several months. But we still have a problem in the housing area, and the fact that many homeowners are reluctant to put their house on the market into this environment, which means that inventories are low. The amount of houses for sale is smaller than it historically has been, and much of it has to do with the fact that homeowners are hesitant to put their home on the market in this environment. And then also, and this is more unfortunate, many people are actually having a problem of being in a home that is not worth what they paid for it. Therefore, they're upside down on their note, and even if they were to sell it, they wouldn't have enough cash to pay off the rest of the mortgage and then also have a 20% down payment to get into a new home, and it's just a big mess. So many people are trapped in their homes, and therefore they cannot sell them. So the inventory issue is still a problem, I think, for most realtors and for many home buyers, as many people are not selling for a variety of reasons. Around the world, as far as the equity markets go, the European stock market is still continuing higher despite having some sluggishness as of late. The Japanese rally has turned around as the yen strengthened. However, the yen is now back on its way down, likely next week, and so we will see the resumption of that uptrend in the Japanese stock markets. Now, I want to tell you something that before I run over and bring Tom Cloud onto the program, I need to tell you this, and I know you probably, some of you who are already FTM insiders, you've said, hey, you've talked about this a couple of times. Well, the reason that we're talking about it on the radio show is because it is now, we're making a very big change as of June 1st, 2013. And that is that all FTM insiders now have access to our daily trading ideas. We call it the Trigger Trade Report. It's a $500 value, and we have decided after much, much time and thinking of putting it into the FTM Insider subscription. The FTM Insider subscription is now $199 per year, and it is $19.95 per month. And with it, you get everything that you've always gotten, but you're also going to receive access to my daily trades. So every single morning before the market opens, you can log into your FTM Insider page and you can see the latest stock idea, the trading idea of the day. And it comes with a buy price and then a stop loss price. And this has been a very popular item that we have been running now for many months. It's been in beta mode now for some time, as we were trying to figure out whether to launch a brand new product with it or to put it into the FTM Insider. Well, we made our decision. It's in the FTM Insider now. So now all FTM Insiders currently and all future FTM Insiders will also have access, in addition to the conference calls, in addition to the newsletter, in addition to the perspectives commentary, and in addition to all the archives, you're also going to have access to this trading idea of the day. Every single trading day, you'll receive a trading idea. And we mustn't forget to put in that we also provide you with our general market conditions indicator system, which currently shows that the market is still in green. It's in a confirmed uptrend. But when that changes, as an FTM Insider, you're going to get an email that's going to alert you that it's probably time to start tightening your stops and start raising cash, start moving to the sidelines, because we don't want to be in stocks and ride it all the way down in the middle of a bear market. That's silly. So all of our FTM Insiders, you'll see that. You'll also see on our website, Jennifer finally put the whole thing together, the whole chart together, going back to 2008, showing where we called the 2008 crisis with this system, and you can see on it how we virtually missed most of the downturn, and then the market indicator system turned green in March of 2009. Does anybody remember what was happening in March of 2009? The market bottomed. Now, our system normally does not call a market bottom, I got to admit. Usually it lags just a little bit because it's a very conservative model. However, this time in March of 2009, it called the bottom with a green light. And Therefore, it was just a wonderful thing that we missed this major downturn and then we were able to see a buy signal once it hit bottom. So we have the whole chart. It's very transparent. You'll see the few mistakes that the system has made over the course of the last several years. However, I must admit that the mistakes have been very minor. It has never missed a major downturn. And as an FTM insider, you'll have access to that. It's green, yellow, red light. Very simple. If it's green, it means it's okay to be in stocks. If it's yellow, it means you need to be careful. And if it's red, it means you need to be raising cash and waiting for the light to turn green again so you can get stocks at a discount. Very valuable service for stock investors. All part of now the FTM Insider program, $199 per year, $19.95 a month. I encourage you to go to ftmdaily.com and become an FTM Insider and receive that daily trade alert and all of the other benefits that come with that. All right, now, that's my commercial for the day, for the week, and I'm very excited that we've made all these changes. I want to move now over to Tom Cloud. Let's get his take on the gold and silver and palladium markets.
Follow the Money Weekly presents your precious metals market update. Here's Tom Cloud.
Jerry, it's been an interesting week. We've seen some big jumps in gold, and we've seen it pull back, but I think going forward we're going to see a lot more volatility until the fall.
Yeah, Tom, I'm really grateful to have you on the line today because I do want to address gold. Obviously, we'll tackle that first, but I want to get to silver and palladium, two metals which both of us believe have a good future, as well as gold, but I want to focus on gold first. It really takes it in the nose with all of this. It's one of the biggest metals, obviously. It's the most liquid, and the financial media just has a great time slamming gold because of the fact that it represents the antithesis of the paper asset world that we found ourselves in, this debt-based monetary society that we live in. And we've been seeing recently that there have been a lot of fears among investors that the Fed was going to pull back this easing, and that caused, some pressure on gold as well as stocks. But for the last 2 weeks now, it looks like gold is continuing to go higher. It seems like the dollar has backed off a little bit. It's not as strong as it has been. Give us your take on gold. And is this recent rally, I hesitate to call it a rally, but this recent rise that we've been seeing in gold, is it sustainable, and what's driving it?
Well, I think a lot. I think the banking news worldwide, Jerry's, people are getting scared. We've even seen, as we record this on Friday, we've seen articles this morning where the right word is not a run on banks in Spain, but clients are taking their cash out. They're readying for a bank problem either in Spain or Portugal, and then it's going to start headed this way. And after all these new crazy bank laws, and even the article I sent out from Ellen Brown, who's written 11 books on banking, when you put your money in the bank, it's their money, basically. And we're just seeing that this banking crisis is spreading and eventually will come to America. Just the question is when, and I think we see a lot of that. And then we're seeing central banks. We saw 4 major central bank purchases at the end of May, created this jump up to the $1,400 level, and we're just waiting on it to close above $1,400 2 or 3 days, and I think we'll have the new base, but still on a technical thing, gold could go down back to that 1320 range. So right now we're cautiously optimistic, but everything I'm hearing from my sources I've known for over 30 years in Europe are telling me this fall, not only for gold, silver, palladium, platinum, all of them are going to have a major jump. But the one thing I'll say that we've got to keep our eyes, and we talked about this earlier on the show, is the debt ceiling. And we now, technically till June the 30th, they just keep putting off. We see Lou, the head of the Treasury, borrowing money from the federal pension plans to keep the government running because they haven't officially raised the debt ceiling yet. And, just out of nowhere, like we saw in August 2011, when they get to it, it's probably going to be right in July or early August when nobody's watching and people are lining up their vacations and trying not to get attention. But that will be the next trigger that we're looking at, Jerry, that will send gold substantially higher.
The managing director over at the World Gold Council named Marcus Grubb reported that Asian gold demand from April to June, that's last quarter or this current quarter, is going to reach an all-time high. It's, in fact, Indian demand for gold is up 200% year over year, even despite the ETF outflows that we've seen. They're buying the physical bullion. And in fact, I don't think many people know, Tom, that China and India together, they account for more than half of the total consumer bullion demand worldwide. We often forget that picture that, just because maybe the U.S. buying has slowed, around the world, it's still propped up.
Well, it is, and a lot of people are looking at this money supply growth. When the figures came out for the first 4 months in the U.S., show the money supply has grown 9%. Well, if you multiply that times 3, we're growing the money supply in the U.S. at 27% through quantitative easing. And for the first 5 months of Japan's quantitative easing, they're growing at 85%. They're nearly doubling their money supply, trying to get the economy going. In England, through theirs, in 3 months, of course, they created 31% more money. I mean, they've almost run at 100% increase on an annual basis. Now, surely they'll slow down the second half of the year, and it won't end up being that much. But we're talking about 3 major areas here running money supply increases at over 25% annualized. And last year in the U.S., we created out of thin air 22% more money. This year we're running at 27%. And next year, if we were to do 24%, we would have doubled the money supply in 3 years. And people just have to realize that is unsustainable. And, of course, a lot of it's going in and creating a bubble in some of the equity markets. Not all of it, but it's helping run those prices up. But the biggest risk, I've always said on this show, and the very beginning, is the bond market. That is the sacred cow. And when those interest rates start popping, and I even feel the bond market may have topped out earlier this week, then when people start moving out of bonds, that's going to be another trigger that's going to send gold and silver up substantially.
Yeah, let's talk about silver, because silver, I've been hearing from all of my sources as well, and I'm sure that you've been hearing the same thing, is that this last half of the year bodes well for silver and, as you've pointed out also numerous times, palladium. But first, let's talk about silver. What's your outlook for the rest of the year for silver?
Well, I'll start out by saying the U.S. Mint, for the first time since 1985, when they started making the silver and gold eagles, hit 4 million ounces in May 2013. 4 million ounces of silver eagles were sold, and that's the reason we've had some delay in getting them. But evidently, we've heard earlier this week, they dropped the premium $1 back to a reasonable amount, and they have geared up, and they've quadrupled their slug order. I mean, the U.S. Mint doesn't refine and make the silver like Canada and Austria. They buy preformed slugs, and then they stamp them into the silver eagle, and they've quadrupled their orders. So they're looking for big demand, and certainly with the money supply growth that we've just talked about, that's the reason a lot of your sources believe that we're not going into a recession. And even though we're printing all this money so far and the economy's not really gained any strength, or we've seen any major inflation, certainly at the rates we just talked about, it's going to come, and silver is going to be very beneficial. This big company I was talking about in Texas that I've sold some large quantities of silver to, they're buying it now because they know they're going to need it in 3, 4, 5 years, and they look at it as the best place they can invest money because they're going to consume it and use it. And they can buy it with spot prices in the $22, $23 range on something even they're expecting to be 40 to 50 in the next couple years. So we're seeing that. And then the little guys, this banking crisis continues to escalate, and we continue to get incredible news that countries like Canada and New Zealand are telling their citizens to put money in banks at your own risk. We're not going to bail you out. And we've already seen what happened in Cyprus. We've already seen what happened in Greece in 2011, where people lost 20% of their deposits. So people are becoming aware of that, and we're seeing, the smaller guy that had gone away from buying gold and silver has started returning in the last couple of weeks, realizing that silver now cannot go down much more, if any. and they're starting to buy. And going back to our webinar, Jerry, 6 or 7 weeks ago, we're still on that RSI that we talked about that night, the relative strength index, right there at that 2258. We've been hanging right around there during the time when gold came down, but silver has stuck, and I do believe that's the bottom, even though a lot of people are talking about $20 or below 21. I still think this 2250 range is probably going to be where it explodes from. So we're hanging around there, but probably not much longer. But I see this fall longer delays in getting physical silver. I see the inventories running down in the COMEX warehouses worldwide. I think that's a given. I see countries begin to take delivery of their future contracts that will absolutely strain the establishments worldwide, because basically their secret will get out if they run out of silver and don't have it to deliver to people. And we're seeing the COMEX bars already being the longest delayed product here at the end of May. We're having 6-week delay on Johnson Matthey bars. So this is unbelievable at a time volume is down. And I can assure you, from doing this for 37 years, the fall is always the biggest volume time for metals. That's when the Indian harvest comes in. That's when the fiscal year ends in the United States. People come back from vacation. You've got the China New Year, and you can go on and on for reasons like you said earlier. But I just keep accumulating during the summer and get ready for, in my opinion, a big escalation in silver in the fall. I feel very confident that silver will finish this year higher than it started at $30 even. So what I'm telling you right now is I expect silver to go up 25% or more in the last 7 months of the year, even if it just gets back to where it started the year at 30. So to buy now, in my opinion, is very low risk.
Yeah, the same thing I'm hearing, Tom. You're reaffirming it. You know, a lot of the big money that I talk to is also expressing a lot of glee that these prices are so low in the run-up towards what you're talking about, that, you know, is that seasonal demand that we see pick up. And so at $22 right now with silver, heading into that time where demand is going to pick up so much, many of the people I know are viewing this as a gift, you know, being able to buy it this cheap. Now, let's talk about palladium, because palladium has bucked the trends ever since it bottomed out, when all the metals bottomed out on April 15th. I guess people had to cash out and pay their taxes. But either way, palladium's just been on a tear ever since, and you called it. Tell us what's happening in palladium and how much more room does it have to go?
Let's start with this. And back in January, when the largest companies in the world came out that in 2012 called the four metals exactly in a row as to which one would appreciate the most, and it was platinum, then palladium, then silver, then gold. That was in 2012. Gold was last place. It went up 7.1, and platinum went up 9.9, so it wasn't a wide range, but all of them went up. But they picked exactly, people I buy the platinum and palladium from, picked exactly the order of appreciation. They came out in January this year and said this year it would be palladium, platinum, silver, and gold. And here we are 5 months into the year. Gold's down 14.5% for the year. Silver's down 22.5%. Platinum's up about 3%, and palladium is up 9% this year. So in other words, they're 31% better off for the first 5 months than silver was. And what most people don't realize, we've talked about many times, is 92% of the supply comes from South Africa and Russia. The Russian area is Siberia, and they've had a problem for years in that they're closed 4 or 5 months a year, so when they have to sell their stockpiles, they put in the market at one time, and it would hurt the price, usually in April and May. But what they're working on now is very similar to the diamonds back in 2000 when Russia and South Africa came to an agreement for South Africa to sell and distribute Russia's diamonds and level out their cash flow. Well, we're seeing the same thing now, and I think it's inevitable that we'll see South Africa selling the Russian stockpiles of palladium and this will level out the years where you won't get as much volatility. But the main thing is, once again, if we don't go into a recession and we see these 8 new car plants built in China and the amount of palladium they've been buying, just that one buyer, you hear about all the tons of gold they buy every month, but you don't hear about the palladium. It's not in the press, but I mean, they're buying large quantities of palladium for the catalytic converter and car industry, and expecting the car sales to continue to increase and no recession. Of course, the Chinese call a recession when the economy's only growing 5 or 6%, where, we call it.
Yeah, that's a nice problem to have.
2%.
Yeah,
so
right.
It's different. But I just watched that palladium. I'd buy it right now. This is a $1,000 metal per ounce sometime between now and the end of 2014, barring a world recession, and I don't see it the way they're printing money. Is it too late to get in? No. I'd be buying. In fact, one of my largest clients bought a substantial amount today as we record this because he got a buy signal from one of his other sources.
Yeah, well, let's talk about that because you do have a lot of large clients who buy en masse. And I think that's instructive to some of the people who have less money to invest, and they're trying to find wisdom in how do I diversify my metals? Do I hold all gold or all silver? So the question is, out of all of your large investors, Tom, how many of them have exposure to things like palladium and platinum?
Well, probably about half of them. I mean, about half of them are just strictly what you call maintaining their purchasing power. They don't look at gold as an investment. They look at gold as money the way it had been historically before the fiat boom after 1971. So they're buying it strictly as a preservation of wealth vehicle. Then you have the other half of them that are interested in trading. They hire timing services to tell them when to get in and out. They buy the metals from me, but I don't tell them when to get in and out. They make that decision, tell me when they want in and out. So it's about 50-50, Jerry, on those that have palladium and platinum and those that either have all gold or 2/3 gold and 1/3 silver. But they just don't delve into platinum and palladium for personal reasons.
Okay, and those with limited funds who are listening to our program, maybe they have some money in gold, they have some money in silver because they're concerned about what's ahead. Would you recommend that any of them cash out some of that and move it into palladium, or is that an unwise move?
Well, I mean, I bunch palladium and silver in the same category. If someone was 2/3 gold and 1/3 silver, I would consider that 1/3 silver to be palladium and silver, or silver. But basically, we do have free shipping on even 1 ounce of palladium. It used to be 2, but they've lowered it now where I can get it shipped to our clients free for just 1 ounce of palladium. So, that's something they could add next time they buy something, is to add 1 ounce of palladium. To sell one metal and go to another, I mean, you got to look at your tax consequence, what you paid for it, what you sold. Do you have carry forward losses? I mean, it becomes a little more complicated, Jerry, than just saying sell something and buy something else, because since Obama's been president, you can no longer trade silver for palladium and be a like exchange. It's now a sale as far as the IRS is concerned.
Taxable event,
so
yeah.
We want to be very careful not to give people bad advice.
Yeah, good. Well, absolutely. That's what we strive to do here on this show.
Right.
Okay,
Absolutely.
So one last thing before I let you go. I wanted to get a real quick update on a more unconventional investment that you have been selling for years, and that's diamonds. We've talked about that in the past. Just give us a real brief update on the global diamond situation.
Exploding, absolutely exploding. If anybody read the Wall Street Journal last week, the incredible article on diamonds and what they're bringing, and people buying them for confidentiality, portability, able to take them anywhere in the world and liquidate them if things fall apart here. Your wife could put them in a temporary ring or necklace and wear them out. It's not anything you have to report. And we're just seeing, I bet my diamond business this year has exceeded last year already in 5 months. They're up about 6% for the first 5 months. So they're doing not quite as good as palladium, but better than any of the other items we've talked about today. And certainly investors should have 5% of their assets in diamonds, GIA graded or only for colored diamonds. If you go into white diamonds, they're doing okay. They're going up, not at the rate that you're seeing the colored diamonds go up. But what's happening now is the pinks, greens, red diamonds now are over $1 million a carat in the wholesale market. And you got blues and greens and pinks now between $50,000 a carat and $400,000 per carat for stones as small as a half a carat. So, these things are so rare, they price themselves out a lot of people's range. But the yellows are still affordable and still marching up. And I think next year in 2014, as we see more and more of this administration passing crazy laws like we've talked about, what the Marketplace Fairness Act and the international gun ban that Obama's supposed to sign on Monday, we're going to see more and more money moving into diamonds. So certainly, Jerry, I'm available to talk to anybody about that. If they'd like to give me a call at 800-247-2812. That's 800-247-2812. And if there's anybody out there that's not on our alerts, they should sign up for them at fpmdaily.com and go to the precious metals, and we'll send them our email blast that go out 2 or 3 days a week. And once again, we don't share our list with anyone. It's completely confidential.
All right, Tom. Well, thank you so much for the update. I know many people are kind of watching this gold, silver, palladium, platinum, and of course, some people are even watching the diamond market closely and have some concerns. So I appreciate you coming on and sharing your insights, and we'll look forward to having you back on next week.
All right, Jerry. It's always a pleasure.
Gold, silver, palladium. If you have questions about or are looking to purchase precious metals, there is one name to know and one name to call. Tom Cloud at 1-800-247-2812. You hear Tom every week on Follow the Money Weekly, and gold and silver are an excellent hedge against inflation. Tom Cloud has over 30 years' experience as a precious metals advisor. Don't buy your precious metals through a call center and pay inflated prices. Call Tom Cloud, 1-800-247-2812. And for a limited time, tell Tom you heard it from Jerry Robinson on Follow the Money Weekly and receive free shipping and insurance on your order. That's right. Mention Follow the Money Weekly and your shipping and insurance charges are waived on your precious metals purchase. If you have a question about something you heard on the show, call Tom. And to secure your precious metals investment, call Tom. Your gold guy, Tom Cloud. 1-800-247-2812. That's 1-800-247-2812. You heard it on Follow the Money Weekly.
Jay Peroni, Certified Financial Planner, here with the idea of the week. This week we'll take a look at an up-and-coming company that is revolutionizing the manufacturing industry. By now you've probably at least heard of 3D printing. The innovations with 3D printing are simply amazing. It allows companies to go beyond mass production with imminent materialization. Thus it allows companies to reduce inventories, saving both time and money. Digital part materialization is an additive manufacturing process, otherwise known as three-dimensional printing, or 3DP, which materializes an object or mold for an object layer by layer out of powdered material, chemical binder, and a digital file. Digital part materialization solutions can now be printed on demand in sand, metal, and glass. The company worth a closer look in the 3D printing arena is X1 Company, ticker symbol XONE. It develops, manufactures, and markets printing machines which produce 3D printed parts and related consumables. It also provides production and contract services to its customers. Here are 3 advantages of X1 Company. Number 1, it has scale, speed, and complexity. X1 offers the largest build sizes for sand and metal in the industry. It's capable of producing parts that could not be made in any other way, and it dramatically reduces lead times. Number 2, it's a total solution provider. It provides 3D design consulting, materials and research, equipment manufacturing and complete contract services, casting services, and training and support. Number 3, it offers industry-grade materials. sand, which is patternless molds and cores for sand casting, metal, it has functional production parts and prototypes, and also glass, soda lime glass for delicate parts and art objects. With decades of manufacturing experience and significant investment in research and product development, X1 has pioneered an evolution of non-traditional manufacturing. This investment has yielded a new generation of rapid production technology in the field of additive manufacturing as well as advanced micromachining processes. Bottom line, I recently added a 5% position to X1 Company, ticker symbol XONE, to our Tomorrow's Treasures portfolio. This is a good buy up to $52 a share. Again, that one is X1 Company, ticker symbol XONE, worth a closer look. To learn more about our Tomorrow's Treasures portfolio, you can go to www.wallstreetrenegade.com. Again, that's www.wallstreetrenegade.com. This is Jay Peroni, Certified Financial Planner, signing off for the Idea of the Week. We'll see you again next week.
All right. Well, Jay Peroni is a CFP Certified Financial Planner, a member of our Christian Financial Advisor Network, and he also manages our very own PACE investment portfolio. If you would like to have a free 30-minute review of your investments with Jay, you can call him at 888-664-6963. That's 888-664-6963. And when you do, be sure to tell him you heard about him on Follow the Money Weekly Radio.
How can you find tomorrow's most profitable stocks before Wall Street finds them? Well, many investors are searching for a place to find stocks that can turn a nest egg into a huge fortune. Since 2009, the Tomorrow's Treasures portfolio has produced annualized gains of 28%, turning a $10,000 portfolio into $21,300. Small cap stocks have had an impressive run over the past 87 years. In fact, small cap stocks have produced 12.1% annually compared to just 9.9% for large cap stock, according to research. Now, this may seem like just a measly 2.1% each year, but the compound effect over the years is astonishing. Consider this: $10,000 invested in large cap stocks in 1926 would be worth $30 million today. Pretty impressive, right? But $10,000 invested in small cap stocks in 1926 turns into over $160 million. Simply put, if you want to build a fortune over the next decade, you must invest in small cap stocks. In fact, all of the top 10 performing stocks of the past decade were small cap stocks. Chances are the top performing stocks over the next decade will also be small cap stocks. So how can you build a fortune? Well, there's no get-rich-quick formula, but good old-fashioned discipline, hard work, and a thorough screening process can pay huge dividends. That's why the Tomorrow's Treasures portfolio was created to help you find the best small-cap stocks today. By investing in underfollowed companies before Wall Street analysts catch on, you can stand to make substantially higher gains as the market drives up share prices. Get started today. Learn how to crush the markets using small-cap stocks. The Tomorrow's Treasures portfolio service may just be what you're looking for.
All right, where's my money?
Money.
Daily bread.
Follow the Money Weekly presents the Retirement Minute.
Hello, everyone. This is John Burse with this week's Retirement Minute. The number one fear that retirees have is the fear that they will outlive their money. 54% of surveyed investors are concerned that increasing lifespans will result in them outliving their savings, according to BlackRock's Investor Pulse survey. 62% of investors polled said they are concerned about having enough income from investments to live comfortably in retirement. Increased longevity is a blessing, but it's an expensive one because that translates into the need for a bigger retirement nest egg and access to secure retirement long income. 73% of respondents agreed with the statement, "Keeping my money safe is more important to me than trying to generate returns. Investors have relied on traditional investments such as treasury bond funds that have delivered annual returns of up to 8% for the past 30 years, stated Frank Porcelli, Managing Director and Head of BlackRock's U.S. Wealth Advisory business. However, if interest rates rise or inflation picks up, investors could lose money. The fact is that trying to play it safe with traditional government bond funds is actually much more risky than many investors realize, says Porcelli. Creating income streams that will last as long as you are alive is an important challenge that must be dealt with in your financial planning, and one that I personally take very seriously, because as long as you have an income coming in, you are never broke. So make sure your financial house is in order, and the best way to start is to contact me at 1-888-914-9909, and I will be more than happy to review your financial situation with you.
Well, welcome back to the program. I'm joined by my good friend, John Rubino. He is the author of Clean Money, Picking Winners in the Green Tech Boom. It was written several years ago, right before, well, they just had a hard time in green tech and clean tech and all of these innovative companies that are coming out with solar-powered vehicles, solar-powered backpacks even. I mean, just an amazing technology that we're seeing. And John is on the line with me. I want him just to kind of fill us in. We've been seeing a massive boom in these stocks this year so far, and I wanted to find out what's going on behind it. Hey, John, how are you doing today?
Hey, Jerry, I'm great.
Great to have you here.
You know, the thing about writing investment books is that timing is really everything.
Right.
And so I really had almost forgotten about clean tech until 6 months ago, because they had just gotten crushed in the last couple of years. And then all of a sudden, out of nowhere, it seems like they became the hottest sector in this market now. Mm-hmm. And 3 or 4 things are at work. One is that there was a huge glut in solar power that was brought about by China getting into the market and basically creating a bunch of companies and giving them insanely cheap financing and all kinds of other help, and allowing them to just flood the world with cheap solar panels, which pushed the price down, which is great for us as consumers of solar panels, but terrible for the companies that are trying to make them at a profit. And so the solar industry just cratered. Nobody was profitable. Everybody's stocks just collapsed. Several other sectors in clean tech went through something like that, though not as severe. You know, the electric car business took a while to get off, even though that had a lot of hype at the beginning and has only lately started to find its footing. And anyhow, lately the imbalances have become less extreme, allowing some of these companies to start putting up pretty good numbers. And that's happened at the same time that the overall stock market is soaring, which is making people a lot more optimistic and a lot more open to new ideas and cool concepts. So combine the two and you get the better run, more successful clean tech companies just rocketing lately.
Yeah, and it makes sense that they would go up because it's innovation. It's these new products, it's these new technologies, and we know from history that, stocks that tend to go up have innovation, they have all of that in their favor. They certainly have technology that they're harnessing. And as you pointed out, China kind of burst the balloon for the whole clean tech. Explain why China getting into the game actually caused the prices to go down here in the U.S. How did that happen?
Well, China decided they wanted to be a big player in clean tech, especially solar, which makes a lot of sense for them because they have phenomenal pollution problems and huge needs for new power going forward. So they facilitated the creation of a lot of solar panel companies that were able to use cheap Chinese labor and extremely cheap financing from the Chinese government and lots of other things like free land and freedom from onerous environmental regulations that other kinds of solar companies in other countries have to live with.
I see.
And so they were able to undercut everybody else in the world. And they just flooded the market with cheap solar panels.
Yeah.
It's not unlike the story of Japan with computer chips a generation ago. Mm-hmm. It looked like they were going to undercut everybody and just run our chip makers out of business, and they came close. Intel was virtually a penny stock at one time because it looked like Japan was going to just subsume that whole industry. And so for a while, it looked like China was going to do the same thing in solar. But lately, well, the U.S. and Europe have been fighting back with tariffs that kind of equalize the playing field a little bit. And the U.S. solar companies have gotten more and more efficient using technology. And so things are starting to balance out now. The Chinese solar companies ended up cutting their own throats along with everybody else's. And so they're in a weak financial state right now and not as interested in just cutting prices year after year the way they had been. So things are starting to balance out in the industry, basically. And now we can get back to looking at who's well-run and who's not, and who might be highly profitable in the future and who has the best technology. You know, all the cool growth stock ideas that you can play with when the industry isn't being destroyed by falling prices.
Well, one of the stocks that's just been so hot, it's been in the news almost on a daily basis, is Tesla. Why don't you tell the audience kind of what's behind that story and why that stock is rocketing higher right now?
Yeah, Tesla's that's the first one we've got to talk about for sure. They're an electric car maker, founded and mostly owned by Elon Musk, who's a very high-powered Silicon Valley venture capitalist who has a hand in a lot of these new clean tech companies. And they got off to a fairly slow start. They were making these beautifully designed muscle cars, you know, faster than any gas-powered sports car and just beautiful and silent. And, you know, a very cool concept. Everybody who drives one wants one. They're very expensive. So they were high-end toys of the elites in their original design. And it took them a little while to get through some early performance problems and generally get off the ground. But lately, they're selling out the production run. They're reporting profits. They've got positive cash flow. Their stock price is soaring. And they were able to do $1 billion financing just lately that allowed them to pay off loans they'd gotten from the government years early. And so now, all of a sudden, they're a very hot growth stock that everybody who follows momentum stocks is aware of and is interested in.
Yeah, it's up over 300% this year, it looks like. Yeah.
Yes, yeah. And their cars are just so cool. There's always a market for high-end cool, right? And their cars qualify right now. If you're Brad Pitt or somebody like that, this is the car you want to drive around. And since there's a lot of new wealth being created in the stock market boom, that creates a bigger market for what Tesla is selling. So barring some kind of serious crack in the market or a serious production problem, and that's always a real possibility with a brand new company like this, they're looking good in the near-term future.
Well, and you think about, you know, when I was growing up, I remember the Jetsons cartoon, you know, and I see people flying around in the sky. And, you know, in some ways, we are in kind of a Jetsons place with all the new technology that we have. But in many ways, we've kind of not made it as far as maybe we thought we might by this time, 2013, that we're doing this interview. Tesla has an electric car, so it's not a flying car yet, but it's an electric car, meaning you don't have to put any gas in it. Is that right? And explain how that works and how sustainable that really is.
Well, it has lithium-ion batteries that you charge as you would charge any kind of other battery. You can plug it in at night, go to your garage in the morning. It's all charged up for a few hundred miles worth of driving around. And electric cars in general are just amazing to drive. I've driven a Nissan Leaf just lately, which is a more mid-range electric car, and it's just a lot more fun to drive than a gas-powered car. And so to the extent that this technology works economically, in other words, to the extent that it can get you where you want to go for near the price of what it costs for a similar gas-powered car, the market is unlimited for these things. And they're not there yet. Their batteries aren't quite as powerful per unit of weight and space as a gas-powered engine is. But they're heading in that direction. They're progressing, and year after year, electric cars get more efficient and the range gets longer. And so that the time is coming. So electric cars will be what we all drive 20 years from now. The question is, what does the curve look like getting from here to there? And Tesla is making the curve look kind of steep. So, there are still a lot of question marks out there, but this is a very promising beginning for the electric vehicle market.
A couple of the companies making news, John, are Solar City, which is a big company, and First Solar. What's the story behind these companies?
Okay, Solar City has a business model that is tailor-made for this kind of a market. Incidentally, it's partially owned by Elon Musk also. So that guy got even richer in the last few months. But Solar City takes solar panels and they'll slap them up on your roof. Say you're in Southern California, and they will lease them to you. So you basically pay them a monthly amount that may be less than what you would have paid for air conditioning from the utility, the electricity that you use to air condition your house, paid Southern California Edison or whatever going forward. So you don't have to put any money up front. You get solar panels on the roof.
I guess they maintain them as well.
Yeah, they take care of everything for you. You're just leasing those solar panels, and you're not seeing any extra out-of-pocket cost. And so Solar City's profit comes from being able to do this at a price that's less than you're paying them.
Right.
And it seems to be working. And one of the reasons that it's working is that the glut in solar panels that crushed the rest of the solar industry made prices go down to the point where Solar City has become profitable. And so they benefit from lower solar panel prices. They're not a manufacturer. They use them. And so their business model was perfect for the environment in which they found themselves. So their stock is rocking lately. And now First Solar is a thin film solar panel maker. They've got a very advanced technology for making very thin solar panels that can just be kind of rolled out or just tacked down on roofs or the sides of buildings or wherever. And they were originally a darling of the European utility industry. German utilities, for instance, were buying huge amounts of First Solar panels and then making big arrays in warm places to generate electricity and send it to cities. Now, the use for these panels is broadening out to rooftop solar on the side of buildings in Arizona and places like that. And at the same time, First Solar is also doing a lot of big utility-scale solar farms. And they're returning to profitability after just getting absolutely whacked. Their stock, I think, was 300 at the peak and then fell to like 11 in the collapse. Now it's back up to 50. So they've had a very nice run lately. And they are financially in pretty good shape. They have positive cash flow. So they have a lot of options. They can buy up weaker competitors and buy half-built solar farms if they want to. And generally, the market has become a lot more optimistic about First Solar.
I'm getting ready for the big backpacking season and the camping season. I just can't wait to get out there. In fact, it's already here. And I've been looking on Amazon for, some camping gear and whatnot. And I ran across a solar-powered backpack. Never had seen anything like it before. It charges mobile devices. You can take power with you. It has, all of these different, gadgets that come along with it. But it's a solar-powered backpack with plugs. So you can plug stuff into it. I mean, that's the kind of innovation that we're seeing. What else do we not know about that's coming from this type of innovation?
Well, solar-powered gadgets is going to be a big market in terms of dollars, but not huge in terms of the solar industry because, rooftop solar is really still the most interesting use for these things. As solar gets cheaper and cheaper, and it is getting much, much cheaper. It was about $80 per kilowatt hour back in the 1970s. And now it's down to 74 cents.
Wow.
Or, I'm sorry, per watt.
Per watt.
Installed power.
Okay.
Yeah. So the downward sloping cost curve broadens out the potential uses for solar. And rooftop is really where I think the growth is going forward because, look at Southern California or Arizona or someplace like that. There's all this ready-made real estate for solar. All these rooftops are out there without solar panels. So now solar is getting cheap enough that you can put solar panels on your roof in Arizona and make money off of it. You save more in utility bills than it costs to put the solar panels up there. And so when that happens, that just opens the floodgates. And as solar gets cheaper and cheaper, this kind of, they call it grid parity. Grid parity will spread to less and less sunny places. And so you've got this massive rollout all around the world that we've got coming in solar because it is getting cheaper and cheaper. Its potential territory is growing steadily. And the benefits of rooftop solar go way beyond economics, too, because it creates something called distributed power, which means we're not relying on a big nuclear plant that can be sabotaged or that can melt down for some other reason. It's all being produced on your roof and being used in your house. So the grid becomes a lot more robust. It can't be sabotaged and taken down because there's no central nexus of power that you can just go after. And so it makes us a lot more stable than we are now, with relying on big power plants with power shipped in from, via huge wires on poles from tens or hundreds of miles away. That's not a robust system. Distributed solar is a very robust system. It makes the U.S. economy a lot more bulletproof. And, for that reason, I'm very excited about the spread of rooftop solar.
Well, several years ago, there was a lot of talk about peak oil, and people were very concerned about peak oil, and then therefore solar and wind power and, hydropower, just all of these different types of alternative energies became very in vogue. And now we have this shale renaissance, or this shale revolution, which in some people say is being overhyped. Other people say that it's, we're not even scratching the surface. But I'm curious what your take is. How does the shale revolution, how does that impact the future of alternative energy? Because people are kind of accustomed to using these types of fossil fuels as opposed to using alternative energy, plus the infrastructure that has to be built. What do you think?
Well, there is an unlimited amount of oil in the world, but there's a limited amount and a shrinking amount of cheap oil. And we've used most of the really easy stuff, the Saudi Arabian oil where you poke a straw in the desert and you get a gusher. Those days are over. And so the oil that we get from shale deposits or from tar sands in Canada, it's there, it's gettable, but it's not cheap. And it also has a lot of environmental issues associated with it that people would rather not deal with if they didn't have to. So it's probable that today's energy prices are pretty much what we're going to see for a while. The new supplies will keep it from soaring, barring some kind of Middle Eastern blow-up or something like that. But the fact that the new supplies are expensive won't let current energy prices fall by too much. And so as alternative energy gets cheaper and cheaper, the lines cross. And so you get solar that works even at today's prices in Southern California, and then wind that works in New England, and solar that works in Ohio 5 years from now or 10 years from now because the prices drop so much. So it's really a question of how fast the uptake happens rather than whether it's going to happen eventually. And cheaper fossil fuels or stable fossil fuels will slow down the uptake compared to an environment in which fossil fuels are getting more and more expensive all the time. But it won't stop the uptake. And at some point, the best of alternative energy will be cheaper than fossil fuels no matter how you slice it. And at that point, then we just... everybody puts solar panels on their roofs or on the sides of their building or on the tops of their cars. It's just another part of the energy mix that it becomes increasingly important. And right now, solar is like 2% of the global energy market. So, it has a long way to grow. It's going to top out at 20%, let's say, which is probably a reasonable target. None of these things are going to take over. But if you get solar at 10% and wind at 5% or 8% and geothermal at 3 or 4% and biofuels at 5 or 6%, it adds up to 30 or 40%, which is a revolution in our market. And that's all very doable with current technology. So let there be some breakthroughs, and then the numbers get bigger and the revolution gets more extreme.
Yeah, it would seem like some of these bigger car companies like Honda and Toyota, going back to Tesla just for a moment, thinking about the money that can be made there, certainly they're paying attention to this, and they probably are already developing their own. I haven't really been paying attention to the solar or the hybrid type of vehicles that are coming out, especially the kind of innovation that Tesla has. What's to say that a company like Toyota or Honda just doesn't take all the market share from Tesla going forward?
Oh, that's the risk with an upstart in an established industry, because Toyota can throw $1 billion this year at research into their next electric vehicle. Yeah. And they've already got hybrids, obviously.
Sure.
So it's just it's an incremental step to an all-electric car rather than a revolutionary step for somebody like Toyota. It's completely possible that Toyota comes out with something that leapfrogs Tesla, and then Tesla disappears. That's the risk you take with investing in an upstart company, because you look at any industry that is now huge, and the original cutting-edge companies, in a lot of cases, aren't the ones who are now. There were 3 or 4 computer companies, for instance, that came and went. And they had cutting-edge technology in their time, but they were surpassed by Apple and by Intel and by Microsoft, the big guys that eventually came along with better ideas and better marketing, et cetera, et cetera. So it's completely possible that, who knows, General Motors is the leader in electric cars 10 years from now. We can't know that ahead of time. And we also can't know what's going to come out of research labs around the world, because the whole world is working on new formulations for thin film solar and new battery technologies. You see battery breakthroughs announced every couple of weeks, where this battery at MIT charges in 1/10 the time and has 5 times the power of whatever is out there now. And so far, those things have not made it from lab to market, but it's completely possible that one of them does at some point in the not-too-distant future.
You've written the book on this. I mean, you've studied clean tech. You've spent a lot of time researching it. You have a website for it. And I'm thinking about an individual who is, just getting started in investing. He wants to, he's young. He sees the opportunity in alternative energy. From your expertise in studying this field and, uncovering a lot of the things that you've uncovered, if you had to place a bet or place a gamble on one singular aspect of alternative energy, which one do you think will outperform over the course of the next 20, 30, 40 years? What aspect?
Well, solar is a given. It's going to be huge. And within the solar industry, it's not easy to pick winners because you've got a lot of companies out there, all of them with strengths and weaknesses. And you've got an environment that's changing rapidly, and you've got all kinds of new tech coming along within the industry. So there is no solar stock that is a blue chip where you can be sure they'll be around 20 years from now, just because this market is so dynamic. So you have to separate the solar industry, which is going to be huge, from any given solar stock, which might or not be around to see it. So you've got to be very careful, and you've got to diversify. And another industry we haven't talked about is smart grid, which is using information technology to manage the flow of electricity and make buildings smarter, and that's going to be huge too. But it also has a lot of issues that make it hard to pick winners, because it's got a lot of big companies, like General Electric, for instance, that makes a lot of the stuff that goes into a smart building, but you wouldn't buy General Electric for this because it's a tiny little niche for them. And then there's a lot of pure play companies that are aggressive and possibly very high growth, but also high risk. So any of these industries, you really have to pay attention and dig in and learn what you can learn about today's market to be able to make intelligent decisions, because, it's like the chip industry of 20 years ago. It's very hard to tell who's going to be the Intel and who's going to be one of these companies we've never, most of us haven't heard of, but they were big at the time and they just fell by the wayside. Another really interesting part of clean tech is the water technology industry. Around the world, we all need water, and we're all running out of water. And so the guys who can supply even just the basic stuff like piping and sensors and things like that will have a huge market for the next 20 or 30 years. And then there's desalination, which is a separate part of the water market, but it involves taking seawater, turning it into drinking water. And that's going to be huge. That's got breakthroughs happening all over the place, and it's getting cheaper and cheaper. And as it gets cheaper, it gets more and more doable for somebody like, for instance, Saudi Arabia to make the desert bloom, with seawater. Wow. And Australia is putting a lot of capital into desalination because they need it. They're a desert, and they're surrounded by ocean. So for that to work, changes the economic calculus for them in a really big way.
So desalination is a possibility now. It's a reality, but it's just not cost effective. Is that right?
Yeah, you can do it. And a lot of people are doing it, but it's not cheap enough to, for instance, replace what farmers get in the U.S. in terms of subsidized water from the U.S. government. You couldn't just set up a desalination plant and replace all that water because your cost would be quite a bit higher. Yeah. But you could replace some of the drinking water in some place like San Diego, where it's already fairly expensive, and they're doing things like that in U.S. coastal cities. So as the cost comes down, and there were just some breakthroughs lately that if a couple of them work, means the cost will be coming down. Then all of a sudden you get all kinds of different cities who are right there on the ocean with a desert at their back, looking at manageable, affordable water. Therefore being able to grow and being able to really to survive in a world where aquifers are dropping and the snow melt off mountains is shrinking and rivers are losing so much of their volume. And so this is coming at a good time.
Yeah, definitely.
There are environmental issues, though, with desalination that will have to be addressed. And that's another roadblock on the way to general acceptance. And that's something that we'll find out in the future, whether they can address them in a cost-effective way.
Very fascinating stuff, John. It's always good to have you on the program. We're out of time. My guest has been John Rubino. The book is called Clean Money, Picking Winners in the Green Tech Boom. John, as always, I love having you on. Folks want to learn more about you and your work. How can they do so?
I run dollarcollapse.com, which has a section on clean technology, along with a lot on precious metals and other things that are also interesting in this market. So that's the place to go, www.dollarcollapse.com, and it's set up to be updated daily with a lot of new information.
Yeah, it's a must-read on my list every single day, dollarcollapse.com. My good friend John Rubino, thank you so much for coming on the program today.
Thanks, Jerry. Enjoyed it.
Well, friends, that brings us to the end of our program. Thank you so much for choosing to allow me into your life each and every week. It is an honor and a privilege to be a part of yours as well. And as always, I leave you with this final word, this time from the book of Psalms 82, verse 3, where it says, "Defend the poor and fatherless, do justice to the afflicted and the needy." It makes us think of what happened recently in Moore, Oklahoma, a town that I have been to, a town that I even have family in. And as we look at what happened in Moore, Oklahoma, that terrible tornado that totally destroyed that town, our prayers and thoughts go out to those who have lost so much, including relatives, perhaps mothers, children, and even fathers. We want to pray for those today and continue to pray for them that they will be restored. As always, have a safe and prosperous week, and I'll see you right back here, God willing, next weekend. God bless.
The views and opinions expressed by the guests on Follow the Money Weekly do not necessarily represent the views of FTMDaily.com or Makers Group Financial, LLC. Even though these are proven strategies, Jerry Robinson is not a financial advisor, and his guests are not legal or tax advisors. You should always consult a trained financial advisor and or tax advisor before making any financial decisions. John Burrs is a registered representative of and does offer securities through Sycor Securities Incorporated. Lifetime Decisions Management Incorporated is not a subsidiary of nor controlled by Sycor Securities Incorporated.